Um, so let me get started here. Just to give you a sort of a quick outline of my presentation, the main idea of I'll kind of start off with talking about some unique insights into the nature and consequences of option trading by retail traders in India. Um, Dimitri already mentioned that we have account level data, which is amazing. So it's like Barber and Odin multiplied by several million. And we have this information not only about retail investors, but also institutions. But the paper is already 90 plus pages. So we decided we are not going to go into the institution side much in this paper, but we have a follow-up piece that we are working on where we're going to actually do more on the institution side. But I'll briefly mention something about institutions that we found. So we have this panel data, which is trader contract day level information. So every day we know what contracts the retail investors are buying and selling. And this comes from the National Stock Exchange of India, which is one of the two main exchanges in India. The other one being the Bombay Stock Exchange, which was the older exchange before this exchange was started. And during our sample period, it actually has 99% of the overall option volume. And I should note that subsequent to our sample period, which ends in 2021, BSE option volume has picked up. But during our period, pretty much everything was going on the National Stock Exchange, which is nice for us. Then I will go into the evidence from three natural experiments, as we call it. Like basically, uh, we have some shocks which are related to intervention by the regulator, who is the Securities and Exchange Board of India, or SEBI in short. So they are the equivalent of SEC in India, and they realize this huge growth in the option tradings by retail investors, and they try to take steps to make it more costly for these traders to participate in this market. So we'll look at two such interventions. Um, in addition, we also have this nice a shock which is related to introduction of weekly options. So most of the paper is going to will be focused on monthly options, but then the National Stock Exchange of India chose to introduce weekly options for one of the index options, but not the other, which is perfect for a difference in differences kind of analysis that I will talk about. And then I'll conclude with some of our takeaways from the paper, where, so sort of to not give away too much, basically, we find a huge amount of speculation going on in this market by the retail traders. And what we will show is that this behavior seems to be quite addictive, and these traders continue to keep trading and lose substantial amount of money. So when we think about financial inclusion and stock market participation, usually we always think about the benefits that you can get as an investor by to earn the equity risk premium and to diversify your risk. But in this particular case, when you're trading complex financial products like options, it seems that it might be a little premature for these retail option traders to jump into this market. And I'll show you some evidence based on the experience of these traders as well, because from the account level data, we can figure out who are the new traders versus the old traders. So that's the kind of the overall outline of the presentation. And now I'll go into the weeds. So just to set the stage here, uh, to give a sense of the scale of the options market in India, $1 is 80 rupees. Okay, so there's almost a factor of 100. But what this picture actually shows is quite striking. So if you actually even compare the dollar volume in the Nifty 50 options. So Nifty 50 are the 50 largest stocks trading on the National Stock Exchange. So this is an index, just like your S&P 500. It's actually closer to like Dow Jones with 30 stocks. So this is 50 largest stocks, the option on the index. If you see towards the end of the sample period, even in dollar terms, it's actually surpassed the S&P 500 index options. So this is the first thing. The second thing is if you actually take the ratio of the derivatives to the cash volume, for India, it stands at 422, which is off the charts. I mean, this is like uh, the other country is kind of hardly visible here because you just see this enormous trading going on in the derivatives market, but not as much in the underlying, which is quite striking as well. So you and in the paper we give more details about the number of traders in the stock market and the volumes there. The option market has just become huge in India, and I'll show more numbers in a few slides, the time trend. So that just to give you an idea about the data that we have. So we have the trader day contract level data on a daily basis on the National Stock Exchange. Um, During the whole sample period, we have about close to 7 million option traders. Um, and although we don't have the income level data, but there was a report which was published by the regulator, SEBI, and they noted that out of these 7 million option traders, three quarters were actually low income traders. Now, this is very important when I'll show you the results to put our results in context because um, these guys are not making a whole lot of money. They're basically making on average less than $6,000 per year. Okay. And I'll show you the magnitude of losses to just keep this number in mind. Um, the other thing which is nice is that our data is not a purely COVID data. It actually starts earlier in 2007. And you can see the growth in the options volume over a relatively long period of time. So we've got like almost 15 years of data. So we can also see what happened both pre and post COVID to some extent. In terms of the details of the data, we have masked ID for each individual and institution. So I wouldn't know if it's Christian Dorion or Dmitry Muriev who's trading, but I would know their ID, and that ID I can track over time. So this allows us to really figure out the volume, profit and losses, all these things at the trader level. Uh, what we have information about is the number of contracts traded, the prices that are being paid for buys and sells for each contract every day. So just to make sure that I don't mislead anybody here, we don't have intraday data. We know at the end of the day what you traded. Uh, we also do not have the data on the bid-ask spread and the commissions that these investors have paid. So this is something that we don't have at the trader level. We can do some estimates based on like broadly what the bid-ask spreads are. If I have time, I can talk about that. We don't use many filters in the data. We just kind of use the whole data, except two things. One thing is that we exclude the very small traders. So these are people who have traded only 5,000 rupees in 15 years. So that's like, if you just divide by 100 just for like $50, $60 for the whole 15 years. So these are very tiny traders. And we also exclude the guys who we call as pro tail traders. So these are the guys who have the top 1% volume over the last 6 months of. These are, we believe, not representative of the retail traders in our sample, but we do provide the results for them in the appendix of the paper in case you are interested. And as I'll show that these guys actually also lose money, but not to the same extent as the retail traders. The median pro tail volume, as I've shown here in the slide, is huge compared to a regular retail. So that's why we think it's not representative. And then the last thing, which we have is we have information on the broker that you use. So are you using a traditional broker or you're using a fintech broker, which is also interesting because that has some implications for the motivation of these traders to trade, and perhaps has implications in terms of the profits and losses in this market. And as we know from the US, like there's a lot of research on Robinhood and how that has changed the landscape of trading. So let me take a pause here in case there are any questions. I'm happy to take it, else I'll keep going.
I don't think there are any questions
Okay.
at this
All
point. I
right.
think you were very clear, right? So we're waiting for the main results.
All right, sounds good, Dimitri. Good. All right. So I promised that I'll show you some data on the growth in this trading. So you have three ways in which you can kind of estimate this growth, right? So one is simply in terms of the number of traders over time. So the first picture here on the top actually shows you the number of retail option traders over our sample period. So towards the end of the sample period, you have close to 1.4 million traders. Okay. And over this whole period, you have 15 times growth in the number of traders. Another way you can do this is in terms of the premium volume. Okay. So if you use the premium volume, this growth is about 86 times over the sample period from 15 years. And then you have the third way you can do it is in terms of the notional volume. And you see this even higher growth in terms of the notional volume. What's also interesting is to understand the demographics of these people um, who are entering into this market. So I have a few slides on that. So here is a picture which shows you the number of traders by experience. So I've just broken it down, the same chart into four categories here. People who have traded less than 3 months, 3 months to 1 year, 1 year to 3 year, and more than 3 years. And what you see is this blue line, the blue bar, the light blue bar actually has jumped up, and it's quite a sizable fraction of the total number of traders who are entering into this market. So in some of our analysis that I'll show you later on, we try to see if there is a difference in the behavior and the profits and losses of these relatively inexperienced investors for us to understand if experience is important in terms of the trading behavior. This is the same thing in terms of the volume per trader by experience again. And you can again see that a lot of inexperienced guys are actually having a sizable trading volume. We also have information on age for some investors, and we can see that most of the trading is by people who are in the 31 to 40 age group, which kind of makes sense because the guys who are much younger probably don't have the income to really trade in this market. So when you start making some money, you're trading and these are the people who again has grown a lot over the sample period. Again, the same numbers in terms of volume. Uh, the gender part is a boys story. You can see that is dominated by the male. So you see that a lot of the trading is by male. So all right. So let me go back to the main slides here. So here is the next thing I wanted to share, which is if you look at the volume, this shows this huge growth. And if you look at the losses and P&L, you see just the mirror image picture. So these guys are losing huge amount of money, and this has become quite substantial in the latter part of our sample period. So at the peak, people are losing 20 to 25 billion rupees, which you convert into dollars is like $250 million per month. Okay. Now, one way you can kind of assess this is by trying to look at how much each trader would lose. And this we can do because we have this account level information. You can see that its per trader loss is like 109,000, 110,000 rupees, which you might think is not a big amount if you convert it in dollars, but you have to keep in mind that the per capita GDP is 98,000 rupees during our sample period average. Um, So you are basically losing your entire wealth, if in a way, by trading in the options market. And another interesting aspect is if you actually look at the bottom figure, if we look at the trading volume and return, most of the losses are being borne by people who are trading actually less, not the more. The guys who are trading a lot, like the pro tail guys, as I mentioned earlier, they are losing, but they are losing less. So the small traders are having disproportionately large amount of losses. And one way to think about this is that there's some wealth redistribution going on from these retail investors to the institutions. So if I have time, basically, if you aggregate the losses, and we check this, if you aggregate the losses of all the retail traders, it exactly matches with the profits made by the institutions, for which we also have the data. So essentially, all the money is being made by the institutions, and I'm sure you people who are attending this presentation have heard about the recent case of Jane Street, which has become has been in the news, and they were one of the beneficiaries of trading in the options market. The next thing I want to talk about is index options. So this is why do I talk about index options? So unlike in the US, where individual stock options are the main market, in case of India, there is a dominance of index options, and we see that majority of the retail traders actually gravitate towards trading in the index options. So in terms of the premium volume, three-fourths of the premium volume is in index options. And if you look at notional, it's even higher. 93% of the notional volume is actually coming from index options. So why are index options? So I have also plotted the single call and single put here. You can hardly see it because it's so small compared to index options. So why is that the index options are so attractive? Well, they offer a larger number of strikes and expirations compared to individual stock options. There's much more liquidity in this market, and this index dominance is even there before 2020. So the COVID happened here, but you can see that the growth in index option is not purely during COVID, but it also started even before that. Um, so index options are, and this is true for both calls and puts. This is another interesting thing here. So you see both these pictures are, so it's not like they're just taking bet on one, in one direction. Also, what is interesting is when people are trading index options, unlike individual stock options, where you may be able to make a story that maybe they are doing this for some information, it becomes sort of less likely that people are trading index options because they have some information. All right, now I will show a few pictures which basically kind of summarize some of the key takeaways of our analysis. So this first picture on the top basically shows you that these guys are not trading in options to hedge. They are trading, they are closing their positions within the same day, and this behavior has become much more dominant by the end of our sample period. So if you look at the end, 90% of overall trading is day trading. Okay. So how do we identify day trading? Because we know your buys and sells every day. If your buys and sells are fully offset at the end of the day, we know that you've traded, you finished trading within the day. But if they are not the same, then we take the minimum of the buys and sells. So you can figure out how much is the open interest for each trader every day. Um, um, the second thing that is striking here is if you look at the bottom picture, what type of options are these guys trading? They are trading short maturity options, especially when they become zero DTE options. So just to make it clear, there are no zero DTE option in India which are issued, but every option will become a zero DTE option at some point. And so what you see is these big skyscrapers at the back of this picture show you that a lot of the trading is first of all going on in short maturity options. So zero is the last row here. So a lot of trading on the last day. And basically what we find is pretty much all the trading is taking place in the 5 days before the expiration. And later on, I'll show you some evidence of why that might be going on to understand it better. Basically, they're trying to go after the skewness into this option. So if you're buying these options which have very short maturity, and these are slightly out of the money options, you can see that here the moneyness is on the x-axis here. So these guys are trading largely in slightly out of the money options with very short maturity. And even I'll show you later on, even if they buy an uh, they buy an option which is a monthly option, they're basically not doing much over the entire month, except towards the end when they start trading in these options. And when later on I'll talk about weeklies, when you have these weekly options, this basically gives them more opportunities to engage in this kind of behavior. All right. So the next thing is about the how long are they holding these contracts. So this is um, the picture on the top here shows you the trade duration. Okay. So even if the option is having 14 days left to maturity, they are holding it for only 5 days. Okay. So first of all, they trade in short maturity options, and then they, even if they are buying the short maturity options, they don't hold it for too long. If you look at the mean duration for which they hold the contract, it's only 2.4 days, and the median is 0. Okay. Um, so most of the trading volume is close to the expiration day. And then, as I said, this is driven more by the new traders compared to the old traders. So the bottom picture actually divides this volume um, between new traders versus old traders. So new traders are the red one, and the blue ones are the old traders, okay, in terms of the experience.
So, Vikas, there is a question in the chat. So people are wondering, like you show convincingly that retail investors lose money, but why exactly they lose money? So what's the main reason that retail investors are losing money to institution? What is the main institutional advantage? So there's a question
Okay,
in the chat.
yeah, thank you very much. So basically, clearly, two reasons that they're losing money. The first is the transaction cost, right? So these are eh, all the profits and losses that I'm showing you are including the bid-ask spread. They don't include the commissions part. So partly they are losing because of the bid-ask spreads that they are paying for these, right? Uh, the second is that there is these guys are simply, a lot of them, and I'll show you the things later on, that they are taking directional positions in these um, without having any information. These are index options, and they are holding it for very short periods of time, just like a lottery type of behavior. And we know that the expected return on a lottery type of thing would be negative, right? So you're basically going to lose um, when you're trying to basically speculate on these things.
Can I also ask a follow-up question from myself? So here, all of this short-term behavior and so on and so forth, there's kind of like not benchmark against institutional investors. I think it would be interesting to see like, hey, this day trading, how much do retail compare to non-market makers? So if we exclude market makers and look at the volume and look at the holding horizons, how do retail differ from non-market makers? Maybe non-market makers also hold for just one day. Maybe non-market makers also trade one-day options. So I would be curious to see how this retail behavior benchmarks against institutional behavior.
That's a good question, Dimitri. I think we've thought about that. And as I said, because the paper is already too long, as you know, you've discussed the paper. So, there's a lot in the paper already. So I think, yeah, because if you're a market maker, you probably have to hedge. And it's not clear how they actually deal with this huge amount of retail trading. So in the follow-up piece, we have the institution trading data as well, and they are probably making the market in this case. So we will be able to see how they trade relative to the retail guys. So that should hopefully answer your question.
And there is a final clarifying question in the chat about do retail investors mostly open long positions or they primarily short options? I assume they mostly take long positions, but
Yeah, so I have since it came up, let me show you this. So here is the and this is again nice for us because we have account level data, so we can actually see if they are taking long positions or short positions. So here you see that majority of the positions are directional unhedged, and these can be both on the call side as well as on the put side, but you typically see more on the long compared to the short. And the answer is simple because if you take a short position, you have to put in the margin, and the long side, you basically don't need much. You just need the small premium to pay. So a lot of these guys are actually trading on the long side. Very few guys actually take multiple call and multiple put. Um, uh, and we also have other ways of looking at directional hedged or volatility bets. These are very tiny. So majority of these guys are actually taking directional positions, long positions mainly.
so no more questions. You have 20, 25 minutes
Okay.
more, and please continue.
All right. Sounds good. So let me go back. Okay, I'm going to skip this in the interest of time. Let me just talk a little bit about the reason why we think these guys are attracted towards buying um, calls or puts with very short maturity and out of the money. So if you look at the table above, what we did is we actually computed the skewness for different moneyness and different time to maturity. And here we have shown the time to maturity from 1 to 6 days because that's where most of the trading is taking place. Okay. And you can see very quickly that the more out of the money and the shorter maturity that you have, it basically blows up the skewness. Okay. So if you are really trying to speculate in this market, where do you get the most bang for your buck? You're basically going to, why? Because you're going to buy these options which have very, very short maturity because they are cheap as well. And so you can see that that's where you get the highest skewness. And if you compare it with the skewness of the underlying, it's just an order of magnitude different. And for comparison, we actually just show these numbers from a paper by Boyer and Working in the JF, where they actually report the numbers for individual stock options. And for individual stock options, the skewness is actually lower compared to what you get for index options, which might be another reason why the retail traders are actually attracted towards index options compared to individual stock options. This question already came up. So we look at the type of option positions. I already showed this, but here is something which I mentioned earlier. So just to reiterate that more than 3/4 of the trading volume is in directional unhedged positions. Okay. And if you look at the single stock options, this becomes even more pronounced. So more than 90% is actually, so this is for the individual stock options. Okay. All right. So since I have limited time, I wanted to spend a little the time on these experiments, these natural experiments, which help us sort of understand a little bit more about the motivation and the behavior of these traders. So I'll talk about 3 experiments. The first one is introduction of weekly options. Okay, so as I mentioned that previous for earlier part of our sample period, all the options were monthly expiration. And there are 2 main index options in India. One is the Nifty 50, which I showed you earlier, which is the 50 largest cap stocks. And for some interesting reason, the second index option that is very popular in India is Bank Nifty, which includes 12 large private and state-owned banks. And together, these 2 index options have about almost 100% of the index options volume. Okay. And prior to 2016, they had only 1 expiration per month on the last Thursday of the month. But in May 2016, the National Stock Exchange decided to introduce weekly options for Bank Nifty, but not for Nifty 50, which is perfect because this allows us to do what we all economists love, the difference in different stuff, because we can actually compare what happens in Bank Nifty compared to Nifty 50. So what do we see? These two pictures, one for notional volume and the other one for premium volume, show you that prior to May 2016, before the introduction of weekly, there was similar trading volume in both of these. But as soon as you have weekly options introduced for Bank Nifty, both these volumes jump. In terms of the notional volume, this goes by 7.3 times, and in terms of the premium volume, it goes up by 2.2 times. Now, what happens to the intensive and extensive margin with the introduction of weekly Bank Nifty? So what we do is a classical DID, and you can see that even if you run the regression, a formal regression with trader fixed effects. So note that we are now looking at within the same trader, you do see a jump of 0.55 million rupees in terms of the premium volume. And in terms of the notional volume, it goes up by 55 million rupees, which is about 56 and 24% jump in the volume. And in terms of the P&L, they are basically losing 6,500 rupees, basically. If you look at the extensive numbers, the extensive margin numbers, 68% of the weekly traders who jump in have zero Bank Nifty experience, and 46% of the weekly traders had zero options experience before. So these are relatively inexperienced guys who are jumping into this market with the introduction of Bank Nifty options.
Vikas, there's a clarifying question about the specification for this table. So this is at the account level, right? So essentially you have like basically one observation would be like one account, or is it account by month? And then how do you cluster the standard errors once you clarify what's the unit of observation?
So let me make sure that I don't give you. I think the clustering I have to check. I think we do it at
the clustering was a question in the chat, but the specification is my question, because I remember like some specification in the paper were like aggregating all of the volume and losses of the account over the entire tenure, right?
Yes. So here we have the monthly data, right? So we have the daily data, but we can actually do this. We can include the daily data here, right? So we have the pre-event period is 1 year before the shock, and post-event is 1 year after the shock here. Okay, so that's what we are using. And the standard errors are clustered at the trader and time level.
Very good.
Okay. All right. And this table basically shows that the jump in this trading and the losses is kind of concentrated among the younger traders. So what we do is we introduce these dummies for based on age, and we look at the gender as well. So these are male traders, young male traders who are losing more money with the introduction of weekly Bank Nifty. So by allowing people to trade more, when you have a greater supply, what we are showing is this actually leads to more speculative behavior and greater losses for the traders. Where is this money coming from? So if these guys are actually trading in weekly Bank Nifty options, what we find very interesting is if we have the stock trading data as well, which is amazing because we have account level data for the stock side as well for these traders. So what we find is that they are actually reducing their investment in the stock market to move that money to the options market. So before the shock, there was a positive net investment, which was about 7% for the 12-month period before the shock. And this becomes negative 4.7 after the shock. So the money is actually going from the stock market. So if you wanted people to actually, households to participate in the financial market, in the stock market, this is the bad news because they are actually moving money from long-term investment to try and engage in speculative trading in the options market. The second shock is related to the lot size. Let me take a pause. Is there any other question, Dimitri, in the chat before I continue?
No questions. Just like Yoko clarified the standard errors, and it's also clarified that all the variables that aggregate over the account tenure, maybe like pre and post, would be nice to have the similar analysis at the account by month level to make it like more comparable. Yeah. There is also a question about the parallel trend for a DID test, but I assume it's somewhere in the appendix.
Yeah, it is there in the paper. I think we show the numbers, but I'm happy to take it afterwards. Yeah.
Okay.
So how much time do I have?
Like maybe 15 minutes.
15 minutes. Okay. So, so the second experiment is related to lot size. So what is the lot size? Lot size is the smallest unit in which the options investors can trade. So what the regulator decided to do when they realized that there are a lot of losses made by the retail traders in this market, they tried to increase the cost of participation by increasing the lot size. And they tripled the lot size for Nifty 50 and doubled the lot size for Bank Nifty. So it went from 25 to 75 and 15 to 30 respectively. So what we want to do is again do a DID to understand how it changed the behavior of these investors. And so what we find is that there is a drop in the retail volume around this shock, which makes sense. This is the intended consequence. This is what the regulator wanted. They wanted, but then what is interesting is it kind of picks up afterwards. What is also perhaps even more interesting is the unintended consequence of this shock. So what happened when the regulator made it more costly for these guys to trade options? Well, they started shifting to out of the money options and zero DT options. So my classical analogy is that when you tell people you cannot drink whiskey because it's very expensive, you start to cheaper liquor. So you don't want to leave drinking, or if you like alcohol, then you just basically shift towards more out of the money options, which are cheaper, and the zero DT options. Okay. So the way we actually set up this DID, since there were questions on the DID before, this is the treated group here is the one which was always below the new lot size. So these are the people who are going, for them, this increase in the lot size will be a constraint, binding constraint. The control group is the one which was even before the shock were always trading above the new lot size. Okay. So 75 and 30 for the two indexes. And so what you see is this is the intended consequence. There is a drop in the volume after the shock. And then they tend to shift to out of the money options, shorter maturity options, and they lose money here. Okay. The dollar profits are flat. This is insignificant, but the percentage returns are negative. All right. The last shock that we are trying to study here is related to individual stock options. So most of the paper is on index options, but there was this interesting shock which actually affected the individual stock options. So what the regulator decided to do was to make to introduce physical settlement for individual stock options instead of cash settlement. And it's very clear that when you have a physical settlement, it will increase the capital requirement. So here is a very simple example based on a Black-Scholes value. You need only $27 for 100 calls, but the underlying value is close to $10,000. So if I make the settlement physical, it requires much more capital from the investors. Now, the exact capital demand will be dictated by the brokers. So because the brokers can have different delivery margins. So in the paper, we provide an example of one fintech broker, which is the largest fintech broker in India, Zerodha, which imposed a margin of 10% on the underlying. on day -4. And this increased to 70% on day -1. So you can see that the margins are, of course, changing as well as the options come to maturity. Okay. So what do we find with this shock? Not surprisingly, if you are holding in the money options, you're more likely to be subject to the physical settlement. So these guys stopped trading in the money options, and they started increasing their trading volume on out of the money options. So there was a 70% reduction in the money options volume, and there was a 55% increase in the day trading volume on the out of the money options. And the same thing we basically test by looking at a regression. So I'm running out of time. I'm not going to. Let me show you a few more things which I think are very interesting. I want to at least show one result with Dimitri confessed he likes a lot on fintech brokers. Hopefully, I'll get to it. So this is so what we also did is we tried to look at the determinants of the entry of the traders from the stock market into the options market. So you might think that these are the guys who are probably the smartest guys in the stock market who are entering into options trading. And what I'm showing you here is that if they had never traded in options, what was their performance in the stock trading account? Unfortunately, these are the losers. These are the people who have lost money in the stock trading who are actually entering into the options market. And these are people who have low experience. So experience is negatively related here. And these are the people who are trading volatile stocks and lottery type of stocks in their trading account. So we use this max measure, which has been used as one of the measures for lottery stock, and we look at the volatility of the stocks. So these are people who are performing poorly in the stock market and are showing gambling kind of behavior even in their stock trading account who are trading in the options market. The next thing we look at is there any learning going on in this market? And what actually determines the exit of these traders from the market? So what we have done is here we have done an independent sort on premium volume and returns. Okay, so you see that the biggest losses are being made by the low volume guys. This is the largest negative number here. There are some guys who are making positive returns. Okay. In terms of the probability of exiting in the next month, you see that the low return and the low volume guys are more likely to exit in the next month, which is not surprising because if you lose money, you are more likely to exit. And if you made money, you are less likely to exit. But what about the return in the next month? Even the winners, they are not showing any persistence in their returns. They are actually losing money in the next month. So winners stay longer, but they suffer from worse performance in the future. So there is no evidence of skill here. So you can think of this like a persistence test. And essentially, the people who are making money in this market might attribute their wins to their ability, but it's just simply overconfidence and some extrapolation of their ability, like as suggested by this paper by Greenwood and Schleifer. So, and this is another interesting thing to try and see what type of options are these guys buying when they're buying individual stock options. We find that these guys are buying options on high price stocks. So if you can't afford Nvidia stock, you buy the option on this because it's a lot cheaper to buy the option, and they tend to buy options with lower premium and shorter maturity. So premium and time to maturity are negatively related. And I already mentioned about they prefer options on stocks with high share prices. All right. The last thing I want to show you in the few minutes I have is related to the brokers. So fintech brokers charge lower commissions and offer trading apps just like you have Robinhood in the US. And what we find is during our sample period, there are 4 fintech brokers in the sample who have at least 60% or more of market share in the final year. And what we find is the traders who trade using fintech brokers trade more and incur greater trading losses. So this is 4,789 per trader per month. So Dimitri discussed this paper and suggested that we should scale it by the period. So we've scaled these numbers now by the number of months for which they are actually trading. And they what we have is, because we have the account level data, we can see if the same trader switched between fintech broker and a traditional broker or the other way around, what happens to their losses. Their losses actually go up when they trade through the fintech broker. So let me show you these numbers. This is just showing you the jump in the trading volume for fintech brokers, which is the blue line here, compared to the traditional brokers. So you see there is the fintech brokers have gained more market share towards the end of our sample period. And here is a test we do. So I want you to focus just on the bottom one where we look at the switchers who switch between fintech broker and traditional broker. And what we find is that the volume goes up when the same trader, these have trader fixed effects, when the same trader trades through a fintech broker, they trade more and they lose more in rupees. Uh, the percentage returns are positive, but there is a loss in terms of the rupee amount. All right. So how much time do I have? I talk briefly about
Maybe a couple more minutes.
couple of more minutes. So I just want to basically say how our paper sort of contributes and what's the main takeaways in the couple of minutes I have. So I think our paper contributes to several strands of literature. The household finance literature is obviously the first one, which is, which kind of shows that financial inclusion improves welfare. I mentioned this diversification, equity, risk premium as being the reasons. But here, what we are showing is by participating in the options market, it actually opens up opportunities for these guys to engage in speculative behavior. And what we are finding is that this behavior is hard to undo. Why? Because even if you make it costly for them to participate in this market, they find other ways in which they continue trading and losing money. The second literature that we contribute is related to gambling, which basically shows that gambling is resulting in loss of welfare. I already mentioned this. And then the retail option trading, as Dimitri said at the beginning of the talk, that there is a huge interest in this. A lot of papers in the last 2-3 years, including Dimitri's work. And there is a lot of these papers are showing that retail options are losing money. What we are able to do is to actually zero in a little bit more to understand the micro dynamics of what's going on in this market. So, for example, we can look at the entry and exit. We can look at performance of individual traders. We don't have to rely on any kind of identifiers. Now, Dimitri's paper is different because he has the count level from the trading journal, but most of the other papers use like some way of determining the retail traders. And then we have these policy shocks, which allow us to say something about how hard-grained this behavior is, or whether you can intervene in this market and change the behavior of individuals. The evidence from index options and looking at brokers is also interesting, which we think contributes to the literature. Some of this is most of this is on individual stock options. So just to conclude, if you didn't remember anything from my talk, what the main takeaways of the paper is that when you have relatively less experienced, uninformed individuals who are coming from an emerging market like India, options market makes it sort of induces them to engage in this short-term speculative behavior, which is welfare destroying, and intervention by the regulator or changes in the supply by the exchange show that this behavior actually becomes more pronounced whenever there are more opportunities. And even if you try to make it costly for them to participate in this market, they find ways to continue engaging in this behavior. So thank you very much for picking up paper again for this workshop, and I'm happy to answer any other questions that people may have.
Thank you, Vikas. So your cohort was very active answering some of the questions in the chat, but I think some of those people can have follow-up questions. So if you feel like asking a question to Vikas, please unmute yourself and go ahead.
Should I stop sharing so that I can see the
No,
people? Because
I
I
think
think you.
yes. Oh,
Hi,
sorry.
Che, how are you?
I'm good. I have one question. I really like the results regarding the fintech versus the traditional brokerage account. I think that's really neat. I'm I'm just curious about in terms of regulatory requirements. Uh, what makes the because not everyone can trade options. So how do you because only certain type of people can unlock different level of trading. And are there any standard regulatory requirements across all
Yeah, I
brokers
should have
that they need
mentioned
to
this.
do?
Yeah, that's a good question. I should have probably mentioned that. And this is probably, you know, one of the reasons why this growth has been so tremendous, because there are basically no requirements. So there is no net worth requirement or an experience requirement as of now for you to participate. So, like when I presented this in China, they said, oh, you can't, in China, if you want to trade, then you have to have a certain income level or net worth, and then you have to, take some test or show that you've traded before in things like this. But here you have, you know, it's free for all. Anybody can participate in this market. So you have cab drivers, like my co-author was taking a cab, the cab driver stopped in between to trade in options.
Okay. Because even in different brokerage I guess in North America, they're required to do certain tests before you even allowed to trade certain type of options and open margin accounts. So I thought if there is some type of heterogeneity at the fintech brokerage in terms
I
of
see.
what is the barrier to entry to unlock different type of trading and especially have a trader fix effect that can help
Yeah, so
really,
that so there is a trader fixed effect in the regression I showed you. I
yeah.
think you probably missed that because there were two regressions that I showed. So let me bring it up again. So since I was running out of time, but let me. So if you see the bottom one is actually having the trader fixed effect shade.
Yeah.
So
But I
this is the
like
same.
the results you're finding that they lose more by trading in the fintech
Correct. That's
account rather than the traditional account. So to me, that's very
yeah.
surprising. Well, not surprising, but very strong uh,
No,
evidence.
so I'll say one more thing about your point about, like, Robinhood just started introducing index option trading in the US. I mean, a lot of these brokers simply ask you questions. Have you traded before? They don't really check if you have traded before or not. It's not like you have to take a formal test and pass, like get a score or something before you can start trading. Uh, so they try to do some due diligence, but that's kind of very loose. That's my sense. I mean, you don't really, and others can correct me if I'm wrong, but Robinhood, like, pretty much people can trade without having any experience of trading in options. And now they're introducing like you can trade cryptos as well. So
Yeah, thank you.
you're welcome.
Anyone else want to ask a question?
Wow, there are lots of things. Thanks a lot, Haibei, for taking all the questions. Will we have the transcript of the chat as well? Thank you so much.
Yeah,
That would be
I'll
very
send
useful.
you. I'll send you.
Yeah, that would be very useful. Thanks a lot, Haibei, for doing real-time stuff. So I had more time to talk, I guess. Thanks to you.
Yeah, there's one more question, I think, from the chat.
Okay, what is that?
Retail traders are trading to get a psychological benefit.
Yeah, I mean, I think that's kind of like a speculative thing. You can make a case that there is a catching up with the Joneses kind of phenomenon, right? A lot of people might be poor and they're just thinking this is the get rich quick thing. And maybe this can explain the behavior of individuals who are low income individuals who are simply